about the incentives is we're buying Chuck E. Cheese tokens before there's a Chuck E. Cheese, right? So like, so that's broken, right? But to me, what I mean by tokenomics may not actually be that hard, is pick a day. Did more people in volume buy or did they sell, right? And then the question becomes, why did they buy, right? And you could split the why did they buy into speculative reasons. Obviously that includes possibly investment reasons, but at the base of it is buying either for ownership of an asset, which is an asset back, or access to a service, which would be a service back.
I think this ties back though to something we mentioned earlier, I forget who said it, but that the terminology is super unclear in this industry, and
yes.
People overload these terms in all sorts of different ways. So when I think about what you're talking about, Miko, absolutely huge question of why people are buying and where is the value coming from in the market. But I think of that as token market economics. So what is actually driving the market value traded on exchanges of a token? And I see that as a separate thing from, again, this is the words that we happen to use at CoinList, the token economics, which to me is the internal economic system of the token. So the token network has a bunch of users on it. If we take Filecoin as an example, there's people that have files to store, there's people with storage space and excess, there's people that validate transactions. And the token economic system, the token economic design are all of those parties appropriately incentivized and disincentivized within the system to do it? And that is mostly irrespective of the actual market price of that token, although it plays a role.
But there kind of aren't, right? In the case of Filecoin, like, I own Filecoin, and I haven't been able to use it to store anything.
Well, but that's the point. That's the point that Jeremy's trying to make, is that if you have a utility token, it's what you're talking about, don't list it on an exchange. The fact that you have a convertible ratio to US dollar value shouldn't exist. The whole idea of utility is that it shouldn't have a relative value to anything else because it's giving you the utility on the network that it's being issued for. On that level, I agree. But the moment you list that token on an exchange and you allow it to be traded at some floating rate, you include, and have to include, and it's irresponsible to not include all the other things that I'm talking about, and I'm sorry if my lens is too narrow-minded here, but the moment you list it on an exchange, liquidity becomes the #1 focus of everybody. It becomes the item in which everybody can see the value proposition, or which removes the utility.
But like, look at the way that CoinList is doing things, because I mean there is a model for this that now exists. You go and sell only to accredited investors early on. You bootstrap the platform to the point where the network's available to be launched, and then at the time of the launch you release a token. Very simple solution to this problem. I mean, this is how token sales should be operating. This is how anybody that actually needs a token should operate. They should only be taking money from accredited investors, people that are qualified.
Why should I only be taking money from accredited
or doing it on a platform like Republic, where there's a platform where unaccredited investors can participate, but not put like too much in. Like I think there needs to be some.
So I think what we're seeing is a shift in investors. Or at least there's a concept called, and you're probably very familiar with CoinList, because the CoinFund guys talk about generalized mining as a shift in how investors start participating on networks. So we went from being an equity investor, because blockchain was the thing that everyone needed to invest in, then it became about the token, and everyone became a token holder, and now we're just bag holders. So we're no longer token holders, we're now going back into equity. And what we're seeing is that later venture capital funds and investors are actually starting to say, we need to be participants on the network. So we need to actually be where we've gone from just being a miner and a user. We now have delegators, we've got validators, we've got syndicators, we've got all these different roles to play on the network, and actually being an investor in the network is now being part of the network, being an infrastructure provider, being one of those nodes, being a validator on the network, and actually contributing to the project. And helping actually build out this network, because it does take time because of all the things that need to happen with it. Actually, that's the role of being a true investor in this ecosystem.
Well, the thing that leaps to my mind, actually, which is kind of the shadow version of what you're talking about, is, most recently, Huobi, one of those crazy centralized exchanges, was basically seen using the user funds to vote for EOS block producers, right? So like, that's just crazy. And the thing that's amazing about that is that's something that's exceedingly visible, right? So as soon as they start doing it, everyone's like, wow, that's a crazy abuse, right? But the thing that's really funny about all of that is that it's actually unknown what's happening behind closed doors, right? Like the stuff that's happening off-chain, we actually have no idea what they're doing.
mean, this is the biggest existential threat to this industry.
Yeah.
It's not that blockchain technology is going to fail, Bitcoin's going to fail. I really just don't think that's going to happen. I mean, with some cryptos may fail, but blockchains, distributed ledger tech, it's here to stay.
Yeah.
The real concern is that we just become Wall Street 2.0. That's what's mortifying to me. I mean, I was when I came into this industry, I was pretty much like the only liberal or progressive in the entire space. I came from Occupy Wall Street. I wasn't a libertarian or an anarchist.
But yet, accredited investors are the ones that need to be able to invest in pre-sale.
Yeah, I mean, look, an early stage startup that's pretty much just an idea is 98% likely going to fail, and selling that product to people that are unscrupulous investors is unethical. I literally do.
So only wealthy people are the people who can have access to new technology.
No, I think there should be access to venture funds. It should be easier. This is what we did with blockchain capital by tokenizing BCAP, like making venture funds accessible for people to invest in. I think platforms like Republic, which vet projects beforehand and allow unaccredited investors to participate in these sales, great ideas. But at the end of the day, you know, the fact is that no matter how great an ICO sounds, it's probably going to fail. And I think we've really got to be mindful of that. I mean, you know, people have lost a lot of money. It's been pretty clear that we can't self-regulate. We can't. The people are too greedy. And that goes back to my driving point here. Not becoming Wall Street 2.0. Because that's what Wall Street does. They just pile shitty, kind of toxic financial instruments on unsuspecting investors, and you know the world suffers as a result.
I don't even think that's a choice. What you're saying, it's not a choice. It's not a choice because ultimately, what's the security? When you take an investment from an investor,
I got to retort to Jeremy. So yeah, I'm going to take moderator's privilege. So to me, like when you talk about like Wall Street 2.0, right? The thing that I think is important to think about is like, when will the centralized exchanges be too big to fail, right? And I think one of the things that we saw.
Well, they were with Gox. I mean, Gox.
That's the point.
That's the point. The first crypto.
That's the point. And when you actually look at what happened with FSA in Japan and the Japanese regulators around the hack of CoinCheck, it's apocalyptic there.
They're not exchanges. They're just websites. They're just companies that.
Yeah, but you're
miss the point. I'm not missing the point here. The point that I'm trying to make is that when we're talking about investors investing in these coins and you're taking money. Well, hold on. When you're taking money from investors, whether you like it or not, they're securities. They're securities because the regulators say they're securities.
The reason why I don't want you to continue is that you keep grinding your lens, and like, you know, it doesn't contribute. So, you know, let's keep this on.
And some of them are not security. I mean, the regulators have come out and
ETH is not a security.
Said Ethereum and Bitcoin are not security.
Correct. But as a general rule, industry-wide,
you can't have general rules when you have a paradigm-shifting technology that spans every fucking industry. It's just that there are no general rules, man. I mean,
and when more than half the value, and especially with more than half the value by market cap of this industry is in the non-securities tokens that exist.
I think they're all securities.
You think Bitcoin and Ethereum are securities?
No, not Bitcoin.
Well, that's
you can't have it both ways.
All right, so let's zoom back. So we do have an entire panel upcoming called Are Security Tokens the Future? So we will have the opportunity as an organization, not us, to talk about this at great length. But to me, what I'd love to do is kind of bat the ball back to Andy. You know, with respect to what you were describing, because one of the things I did want to honor is that when you describe incentivization, I really feel like that's in some ways a crux, right? And it's a crux in the sense that like people who are blockchain but not Bitcoiners are really focusing on the wrong layer, because the layer that produces the most effect is incentivization. So just kind of wanted to kind of bat it back to you and talk about kind of investment from the perspective of incentivization.
Yeah, it goes right back, and it's a great question. It goes right back to what Yossi was saying after we talked about that, which is the value accrual is the most important part of this. Blockchain technology is incredible. Like Jeremy said, it's here to stay. But it is a means to an end of designing effective incentive systems that will result in decentralized distributed networks of human beings and machines collaborating to produce results that make sense for the world and result in more economically efficient markets. That is a beautiful thing, and it only works when those markets actually accrue value as a result of those tokens accruing value in those networks. So when we talk about incentive design, it is about when all these parties act together in the right way, does the token that they are using as a means of exchange or store value or whatever it may be, unit of account on that system, grow in value? If it does, that is a successfully designed token.
Well,
what we should all be
hold on,
focused on
Andy,
is how do we design these incentive systems positively?
I think that's great, but we've just missed the point this entire panel. We're talking about like the what and the how. We're not talking about the why. Like, why do you want to use blockchain technology? We haven't answered that once on this panel. And I think if we're talking about investment, we have to talk about why do you use a blockchain? And there are really two core driving reasons: censorship resistance and the disintermediation of middlemen. If you're not doing one of those two things, you probably don't need a blockchain. And that's why 95% of the companies in this space are crap, because they're not actually solving a problem that's solved by a blockchain. Blockchain is just a pretty buzzword. If you don't have an application that's at risk of being shut down by your local government, by like being hacked by banks or like large supranational entities that want to take you down, or hackers, you probably don't need a blockchain. But there's some cases where you just want to disintermediate middlemen. You want to get rid of like centralized land title registries, and that's great. But if you're not answering those two things, you probably just don't need a blockchain to begin with. And that's what we really need to focus on. Before we design incentive systems, do we actually need a decentralized system to begin with? Because guess what? Centralized systems are a hell of a lot easier to build, maintain, and make operate for, your average consumer.
So to answer that question directly that you asked, I totally agree with Jeremy. Step one, does this system even need a blockchain? If no, do not move on. But if yes, then you sit back and say, is the incentive system designed well enough to support the value of the token in the long term? If yes, maybe worthwhile as an investment. Still obviously very risky to the points made earlier. But if those incentive systems aren't there, you should not be investing in that token.
Okay, well, we ran out the clock. What I do want to say, just in closing, is that we're all here for good reasons, which is we want to deliver and ship software that adds value. And so, I think that's what the investment community needs and wants, and that's what this industry needs. So, let's get to work. All right, thanks everyone.